You already know the federal government taxes up to 85% of your Social Security benefits if your income crosses certain thresholds. What most retirees do not know, what no one at the Social Security office ever mentions, and what the retirement brochures printed by state tourism boards conveniently leave out, is that 10 states still reach into your Social Security check a second time, after the federal government has already taken its cut. That is right. In 2026, if you live in the wrong state, $1 of your Social Security benefit can be taxed twice. First by the Treasury in Washington, and then again by your state revenue department in the capital city down the road. The states that still do this are shrinking in number year by year, as political pressure from aging voters forces capital after capital to exempt Social Security. But 10 of them are holding on. And if you are a retiree living in one of those 10, or if you're about to retire in one of them, the cumulative cost over a 20-year retirement can easily exceed $50,000. That is not exaggeration. That is simple arithmetic applied to the published tax rates and the average benefit amounts. Before we go through the list, I want to be transparent about what this video is and is not. This video is for educational purposes only and is not personalized tax, financial, or legal advice. Consult a qualified professional for guidance on your specific situation. State tax rules change frequently, and a bill in your state legislature could change your situation between the time I record this and the time you watch it. What I share here is drawn from publicly available State Revenue Department guidance as of early 2026, and the specific numbers for your situation will depend on your age, your filing status, your total income, and any state-specific modifications. The 10 states that still tax Social Security benefits in 2026, to some degree and with various exemptions, are Colorado, Connecticut, Kansas, Minnesota, Montana, New Mexico, Rhode Island, Utah, Vermont, and West Virginia. That number has come down significantly in recent years. Missouri, Nebraska, Kansas, and others have phased out their tax in recent sessions, and several of the 10 still on the list have scaled back the amount they tax through income-based exemptions. But the 10 on that list still pull some amount of tax from some retirees' Social Security checks in 2026, and the details of each one matter. Let me walk you through a few and then talk about the strategy. Consider Minnesota first, because Minnesota has one of the more complicated formulas and one of the highest state tax rates on retirement income. Minnesota allows a Social Security subtraction that phases out at higher incomes. A married couple with provisional income below about $106,000 gets a full subtraction in 2026, meaning they pay no state tax on Social Security. But above that threshold, the subtraction phases out, and by the time the couple's income exceeds about $140,000, they are paying Minnesota's full 7% on every dollar of Social Security. For a couple with $50,000 in combined benefits, that can mean $3,500 a year in state tax on the benefits alone. Joyce and Thomas live in Duluth. Joyce worked as a hospital administrator for 30 years. Thomas ran the maintenance department at a lumber mill until he retired at 64. Their combined Social Security comes to $48,000 a year. Thomas has a pension of $18,000 from the mill. They take about $20,000 from a traditional IRA to fund travel and home maintenance. That puts their adjusted gross income near $90,000, well below the phase-out threshold, so they qualify for the full Minnesota subtraction. Their friends down the street, Nancy and Walter, have higher income. Walter was a regional sales manager who built up a much larger 401k, and their combined income runs closer to $150,000. Nancy and Walter pay Minnesota state tax on most of their Social Security benefits, which works out to about $3,200 a year that Joyce and Thomas do not owe. Same Social Security benefits, different outcomes based on other income. Colorado takes a different approach. Retirees 65 and older get a pension and annuity subtraction up to $24,000 a year, and that includes Social Security. Below 65, the subtraction is smaller. For most retirees over 65, with moderate Social Security benefits, the $24,000 cap covers the full amount, meaning no state tax. But if your Social Security plus pension exceeds $24,000, the excess is taxed at Colorado's flat state rate, which sits around 4.25% in 2026. A couple with a combined Social Security benefit of $40,000, both over 65, each getting the full $24,000 subtraction for their combined pension and Social Security, might escape state tax entirely, depending on how their income splits. The details matter enormously, and the Colorado Department of Revenue publishes worksheets specifically for this calculation. Connecticut exempts Social Security entirely for single filers with federal AGI, below $75,000, and for joint filers below $100,000. Above those thresholds, the exemption phases out, and the highest earners pay Connecticut's progressive rate on a portion of their benefits. For a middle-income retiree in Connecticut, Social Security is essentially tax-free. For a higher income retiree who also has a pension and substantial IRA withdrawals, Connecticut still reaches in. Kansas, despite recent reform, still has a tax structure that affects some retirees, with an exemption that applies to lower income taxpayers but phases out above certain income levels. Always check the most recent state tax instructions, because this is one of the states most likely to change in the next legislative session. Montana taxes Social Security in a way that mirrors the federal rules, but with a smaller base exemption. Most retirees in Montana who pay federal tax on a portion of their Social Security also pay state tax on that same portion. The rates are moderate, but the interaction with other retirement income can push the total state bill into the thousands. New Mexico eliminated its Social Security tax for most middle-income retirees in recent reforms, but a portion of higher-income retirees still see state tax on their benefits. The thresholds in 2026 sit around $100,000 for joint filers and $75,000 for singles, above which a graduated tax applies. Rhode Island provides a full exemption from state tax on Social Security. If your federal AGI falls below about $115,000 for a joint return and about $92,000 for a single. Above those thresholds, Rhode Island taxes the same portion that is federally taxable at its state rate. Utah applies a tax credit approach, where the state income tax on Social Security is partially offset by a credit that phases out based on income. For lower income retirees, the net state tax on Social Security is effectively zero. For higher income retirees, the state still collects a measurable amount. Vermont exempts Social Security for single filers below $50,000 and joint filers below $65,000, with a partial exemption phasing out at higher levels. Above about $75,000 for joint filers, the full amount of federally taxable Social Security is also taxed by Vermont. West Virginia has been phasing out its Social Security tax, and, depending on the phase-in schedule, may tax a declining percentage in 2026 compared to previous years. Retirees should check the West Virginia Department of Revenue guidance for the current year. So what does all of this actually cost? Let me give you a concrete range. A retired couple receiving $50,000 in combined Social Security, with additional retirement income that pushes them into the fully taxable portion at the state level, can pay anywhere from $1,500 to $4,000 per year in state tax on their benefits, depending on which of the 10 states they live in. Over a 20-year retirement, that compounds into $30,000 to $80,000, and that is just on the Social Security component. The same states generally also tax pension income, IRA withdrawals, and Roth conversion income at varying rates, so the total state tax bite on a retiree's income can be significantly higher than the Social Security portion alone. Here's a trap that catches many retirees who move in retirement. They assume that if they leave a high-tax state, they escape the tax. But state tax is based on residency, not on where your benefit check originated. If you move from Illinois, which does not tax Social Security, to Minnesota, which does, your benefit is now subject to Minnesota tax. The Social Security Administration does not care which state you live in. They send the check. Your state of residence determines the tax. The same is true in reverse. Retirees who move from one of these 10 states to Florida, Texas, Nevada, or any of the other states without income tax see an immediate reduction in their state tax burden. Some retirees make that move specifically for the tax savings, but relocation is a major life decision, and state tax is only one input. Property taxes vary enormously, sales tax varies, cost of healthcare varies, proximity to family matters, climate matters. If the tax savings are $3,000 a year, but the cost of living in the new state is $8,000 higher, you have actually lost money. Run the full comparison, not just the income tax line. Another trap is failing to update your state of residency when you do move. Form 8822 is the federal address change form, but you also need to update your state tax agencies, your Social Security Administration records, your driver's license, and your voter registration. A retiree who physically moves to Florida but keeps a Minnesota driver's license, votes in Minnesota, and maintains a Minnesota address on their tax returns may still be considered a Minnesota resident for tax purposes. States with aggressive revenue departments will audit retirees who claim to have moved but left too many ties behind. The general rule is that establishing a new domicile requires more than just buying a house. You need to sever meaningful ties with the old state and demonstrate intent to make the new state your permanent home. A third trap is misunderstanding which income sources trigger the state tax on Social Security. In some states, tax-exempt municipal bond interest counts toward the income threshold that determines whether your Social Security is taxed. In others, only AGI is used. In a few states, even pension income from another state counts toward the threshold. The interaction matters because a retiree might believe they are safely below the threshold based on their federal AGI, only to discover that a state-specific add-back pushes them over. Helen and Frank retired from Southern California to a small town in Montana. Helen had been an accountant for the county. Frank was a high school football coach. They expected Montana to have lower taxes than California, which is true for most income tax categories. But they did not realize that Montana taxes a portion of their Social Security benefits that California does not. Over their first few years in Montana, their state tax bill was about $1,800 a year higher than they had projected, entirely due to the Social Security component. They still saved money overall because Montana's property tax and sales tax environment worked in their favor, but the Social Security line was a surprise that required adjusting their quarterly estimated payments to avoid an underpayment penalty under Form 2210. Here is what you can actually do about this if you find yourself in one of the 10 states. First, get clear on your exact situation. Pull your last state tax return and find the line where Social Security is taxed. See what amount is being taxed and at what rate. Calculate the annual cost. Project that number over 20 years using reasonable inflation assumptions. Now you have a baseline for the cost of doing nothing. Second, explore whether withdrawal sequencing can reduce your taxable Social Security at the state level. Some of the 10 states use federal provisional income as the basis for the state tax, which means strategies that reduce your federal provisional income, like drawing from Roth accounts or delaying IRA withdrawals, also reduce your state tax. Others use federal AGI, which responds to the same strategies. A few use state-specific calculations with their own add-backs. Know which formula applies to your state, because the strategy changes accordingly. Third, consider whether a Roth conversion in a low-income year can reduce future state tax on Social Security. If you can pay tax on converted amounts while your income is temporarily low, you lock in a lower future state tax rate and reduce your eventual RMDs. The Roth distributions in future years are not counted in provisional income, so they do not push you into the phase-out range. Fourth, if you're considering moving, run a full tax comparison with a state-savvy accountant before you commit. Many financial planners do not know the details of state tax rules, particularly in states you are moving to rather than from. An accountant who works with retirees in both states is the best resource. Fifth, stay engaged with your state legislature. Several of these 10 states are actively debating further reductions or complete elimination of the Social Security tax. Your voice, your letters to your state representative, and your vote do matter. In the past decade, several states that were on this list have fallen off it because retirees organized and pushed for reform. The political momentum is moving toward elimination, but it moves faster in states where retirees are active and vocal. Sixth, be careful about how you file. Some retirees in phase-out states leave money on the table by not claiming all the subtractions and exemptions they qualify for. The state tax forms can be confusing, and the instructions change every year. If you are using tax software, make sure it is updated for your state's current year rules. If you are using a preparer, make sure they specifically understand your state's retirement income rules, not just the federal ones. A final note on federal-state interaction. The federal government taxes up to 85% of Social Security benefits based on provisional income. In most of the 10 states, the starting point for state taxation is the federally taxable amount. So if you reduce your federal taxable Social Security, you usually also reduce your state taxable Social Security. Strategies that keep your provisional income below the $44,000 threshold for joint filers federally also help at the state level. QCDs, as I covered in another video, reduce adjusted gross income and therefore provisional income, which in turn reduces state tax in most of these states. The tax planning tools are interlocking. If you have been watching without realizing which state you live in is on this list, go check. Pull your last state return and look for a line item related to pension or Social Security income. If you see an amount there, you are paying state tax on your Social Security, and there may be planning opportunities you have not explored. If you see a subtraction or exemption that zeroes it out, you are currently protected, but the threshold could change in future tax years as your income shifts. Before I close, I want to acknowledge that none of this is inherently fair. You paid FICA taxes on every paycheck for 40 or 50 years. The Social Security benefit is money you already earned, already contributed. The federal taxation of benefits was controversial when it was enacted in 1983, and state taxation layered on top feels, to many retirees, like a second bite from the same apple. The politics will continue to evolve. The best you can do is understand the rules as they apply in 2026, plan accordingly, and make sure you're not paying more than you owe. I want to invite you to think of someone in your life who might not know this information, a parent, a sibling, a neighbor, a coworker who's about to retire. Send them this video. Start a conversation. These 10 states are not random. They are specific states with specific rules, and the difference between knowing and not knowing is measured in thousands of dollars over the course of a retirement. The more retirees who understand their state's rules, the more pressure builds on state legislatures to finish what they have started and eliminate this tax entirely. Until that happens, awareness is the protection. Stay careful out there and keep your eyes on the details. The mailers from your state revenue department never quite explain.